So some general rules of thumb is if you're going to invest in people, by year two, you should be getting at least a 3-to-1 return on your people. Like they literally are going to generate at least 3 times the revenue, or depending on your type of business, gross profit, than your all-in cost on that person. By year two, year one is an investment. CapEx, for example, the rule of thumb for normal CapEx, like equipment and those kind of things, is a 24-month payback, right, on CapEx. And then other ones can be made for investments or investment in business units, making an acquisition. A lot of times they're looking for at least a 30% IRR on that. Some will have a lower threshold and use 20%, meaning they're
As
going
I
to
hear you
invest those
say that,
dollars.
Kevin, it's
Mhm.
interesting. So every time we talk, I have something to write on and something to write with. I can't help but do it. I'm always getting new ones here. I'm going to come back and talk about that Buffett one at some later point with you. But I was writing out my little chart, how I think about this as we were talking. And so I've coached lots of business owners and I've given them a rule of thumb. So first of all, we need to think of the scale of the business. So let's say it's a $10 million a year revenue business, 20%
Mhm.
operating profit margin. So 10 million top of line, 2 million profit. It's probably a bread and butter client for you and for us,
That's
right?
right.
That kind
Yep.
of middle of the road company.
That's right. Bread and butter all day long. Yep.
And so the way I tell them is I'll say, look, if you're going to spend 50 or 100,000 or 125,000 on X, that should be paying for itself within a year, maybe 2 years, but probably pay back within a
Mhm.
year.